Welcome to Investors Insights. Our topic today is inflation and the 1970s. Oh, that's a topic. Those of you watching this vlog that lived through it, you need to stay with us. Those of you that didn't live through the 70s, you need to learn and understand why people are concerned about inflation. I'm excited today because my colleagues have done an excellent job in their research. And we wanted to start this week off with that conversation about inflation in relation to the 1970s. Why? We're getting a lot of questions about that. People are starting to get concerned as the Fed raises interest rates and as they see the cost of things, of goods going up. So, Bobby, one of the topics in the 1970s was bond valuations. As interest rates go up, bond values come down. As interest rates come down, bond values go up. There's a whole strategy there. You discussed that in our meeting today. And so elaborate and let's talk about that.
Like Greg said, we've been getting a lot of questions about bonds and interest rates recently. So I want to talk about that for a minute and give an update on bond prices relative to changes in interest rates. So bonds obviously are an important piece in a diversified investment strategy. And the best way to give an update on bonds is by sharing this chart that shows the current price of 8 of the bond indices we like to track, including corporate and government bonds. As you can see, all 8 are trading at below par, which is the value if held to maturity. The current valuations are seen in the blue columns. So over the past 18 months, the Federal Reserve, through its inflation fight, has raised the federal funds target rate, sending it soaring to 5.5% as of July 26th of this year. As many investors are aware, bond prices and yields typically move in opposite directions. Therefore, an increase or decrease in bond prices could be an indication that yields have fallen or risen, respectively, over that period. But what's interesting is that while not captured by the time frame in this chart, 7 of the 8 bond indices referred to in this chart were actually above their par values as of December 15th of 2021. So you can see that the current valuations have fallen below par due to the Federal Reserve raising rates. We use this chart in analysis as we manage client portfolios. And while volatility has provided opportunity in the bond market with bonds trading below par, we know to be cautious as the Federal Reserve might not be done with raising rates. Therefore, certain bonds remain under pressure. So we're taking advantage of certain sectors of the bond market by purchasing bond positions below par, knowing that if held to maturity, these bonds will mature at a higher price than when we bought them. So a quick update on bonds there.
Yeah, no, and it's a dynamic we haven't had to deal with in some time. We are seeing in terms of bond yields, we're also seeing in terms of money markets, CD rates up, and so we're taking advantage of bonds at a lower valuation. There could be some great opportunities there. That kind of volatility occurred in the 1970s and on into the 80s. People forget, and I'm not proposing that this is going to happen, but the only time in the history of our nation that we had double-digit interest rates were 1978, 79, 80, and 81. That was a volatile time for bonds. And we've got a great opportunity here to take advantage of, and we're watching it closely. Now, Ty, you really addressed about inflation and people thinking, well, it's about over, it's peaked. You jumped in when Bobby started talking about bonds in our discussion this morning. So go ahead and educate our folks on that as well.
I'll start out with, as we all know, the Fed raised rates again last month. So according to data by the CME FedWatch tool, there's only about a 30% chance of another hike for the rest of the year. These figures can, of course, change, but the dialogue now will more shift to when can we expect a rate cut? I know a lot of you are hoping for a rate cut for, mortgage rates to go buy that car, things like that. Well, right now, we're seeing pretty low probability that there's going to be a rate cut this year. The Fed seems content on just maintaining rates. And so a lot of people may say, well, why would they do that? Inflation is coming down. Why are they so determined to just kind of keep these elevated rates for a while? Well, when you couple the, commodity inflation we've seen recently, oil and gas, I know, gas has gotten more expensive,
Yes.
Steel, copper, things like that going up. And then you couple that with the increase in the money supply we've seen recently, it kind of makes sense that the Fed is just trying to make sure they kill inflation and not relive another 1970 inflation case. So in this chart, you can see that CPI and which is the primary metric we use for inflation, and money supply growth correlate pretty well, where money supply growth it leads CPI by about 16 months. And so as you can see in the chart here, back in, during COVID, we're issuing stimulus, we're issuing new money. The money growth goes way up. 16 months later, we have 9% inflation. People are saying, what happened? Well, as the money supply, we've gradually brought it down from those elevated levels. It's actually been negative this year for the majority of the year. Inflation has come back down into, where we're at now. That's very encouraging. But I would stress that, we've seen a little bit of a tick up in money supply recently. And the Fed is obviously keeping an eye on this to make sure that inflation doesn't follow suit. Now, 5% growth in money supply is nothing major. That kind of correlates with the 2% inflation target that the Fed likes to have. But if we start getting back to those COVID levels, inflation is going to be back, and it's going to be like the 1970s where, we just can't get rid of it. So the Fed is going to maintain rates here for a while, it looks like, until they get the data they want. So we don't see this constant reflation.
The Fed is looking closely at history, and the 1970s is a great study of what the Fed did in the 70s. And you've made a really valid point that there's always been debate and discussion that maybe the Fed lowered rates too soon. If they had maintained them higher for a while, we wouldn't have gotten to those double-digit interest rates. And so I thought it was excellent observation, and that we needed to share that with our viewers, and appreciate the research you did on that, Ty. We hope you have a great week. We hope this vlog has been well worth your time. As the week progresses in our social media, Facebook, Twitter, LinkedIn, on our podcast, on YouTube, we would really appreciate any feedback you want to give us. We also appreciate those of you that are sending it to others. We are constantly thrilled to hear from folks that go, hey, I got this vlog from a friend of mine who's a client of yours, and I have additional questions. We're frustrated educators here at File Plan Partners, and we like to discuss it with people. So anyway, have a great week. Thank you so much for believing in us, and know that each and every day we're striving here at File Plan Partners to see to it that our clients' lives are better, richer, fuller. Thank you.